Well, good morning and welcome to Financial Accounting. Today, we're going to be starting Chapter 8, which means last class we finished Chapter 7. So as you can see on the schedule, the Chapter 7 problem should be submitted for grading by the end of the day today. And the Chapter 8 pre-quiz should also be submitted, as always, 60% or higher to get full credit for that. On Thursday, then we'll be finishing up Chapter 8, so the Chapter 8 exercises are due. And next week we'll be moving on to Chapter 9. So please keep that in mind as you're planning your time here. Chapter 9 is the last exam, the last chapter before our next exam, before exam 3. I did schedule review sessions for each of our remaining 3 exams. I will put the dates for those in the announcement today after class. I had asked people to weigh in if you had any preference about times, and since nobody did weigh in, I had to go ahead and schedule them. I needed to get them on my calendar. So when you go into Starfish, if you do want to be able to attend one or more of those sessions, you go into Starfish in the My Courses area. You should see the link for those review sessions. I have each one of them labeled review for exam 3, exam 4, exam 5. And obviously by the date, you can tell which exam they're for as well. I would encourage you to attend those if you can. They're all either on a Monday or a Wednesday. And generally, maybe all of them are at 9:30 in the morning. So do not skip another class that you might already have at that time. If anyone is there, if we have a review session, I will, of course, record it, make those recordings available to you and to the asynchronous online class for people who might wish to attend or benefit from those, but can't come at that particular time because you have a class, because you work or whatever. So I will be sharing those dates after class today, and I will also put them in the announcement, but you can also see them in Starfish. Questions about that? Okay. Next item of business. So I've been fighting with Brightspace. Some of you are aware of this. When the first annual report project was due, for some reason, and I'm taking responsibility for that, Brightspace was new. For some reason, I had apparently either neglected to change a default setting. That's probably what happened. And so when it hit the due date, the Dropbox closed, which was not my intention. And so when it was brought to my attention from someone who was trying to submit after the due date, I had to reopen it. And when I reopened it, it actually created what appears to be a new Dropbox, even though it's in the same place in Brightspace. So you can only see one Dropbox in that folder for the part 1 of the project. But in the grade book, there are actually 2 separate part 1 projects. And so I've been trying to figure out how to get them to merge. I've tried a number of different things, didn't work. Our Brightspace person, our expert on Brightspace, hadn't ever seen that happen before when I asked her about it. And so I finally decided I've just got to move forward. I've got to get those graded. And so what I had to do was tweak the grade book by allowing it to keep both of those, but telling the grade book to drop one of them. And so I know someone already noticed it this morning and was concerned that you saw a 0 in the Dropbox in the grade book. And it said, but I know I turned it in. So I did put feedback in there that says this is a placeholder. And so if you look at the feedback, you will see that if you see your 0. You also should have noticed that a 0 wasn't figuring into your grade if you look at the summary column for the annual report project. But so that's what's going on with that. And as soon as I finish getting all those grades in, which hopefully happens by the end of the day today, you will see in that annual report project total column that only one of the grades is counting. So the 0 is going to be dropped. Unless you didn't turn it in at all, and you've got zeros in both columns, and one of those zeros, of course, is going to count. Okay, so I apologize if that created any concern for everyone. I just did it this morning, shortly before class, and I thought, oh, I can just explain it in class and nobody will be concerned. But obviously, at least one person did notice and was concerned. So I apologize for that. But it does say in the feedback that it's just a placeholder. And if you notice, if you think that your grade is calculating oddly, just let me know. Everything in there does match with what the syllabus says as far as the weighting of the categories. Each one of the projects is given the same weight. So you may notice as we go through the semester that they may not all have the same number of points. So project 1 has 18 points because there were 18 questions. Project 3, if it has 27 questions, it doesn't, but if it did, I can make that 27 points, but it's still going to get the same 20% of the weight of the annual report project, which is 15% of your total. So it all works out in the end, but what it means is you can't just add up the points to be able to calculate your grade. You have to look at the proper weightings. If you do have a question about how your grade is calculating, you can let me know. You can see in the grade book now, you can see the column that says final calculated grade. And it shows your letter grade based on what the syllabus says for each letter. And it shows your average as a percent. So again, if you do have questions about that, I'm happy to answer them. And I certainly don't want there to be anything in there that's not what you were anticipating based on what I told you back in August. Okay, questions about any of that administrative stuff? All right, how about chapter 7, cash and internal controls? Any questions about anything we talked about in that chapter? You should be finishing up the homework problem today or by today, if you haven't already, as you know. Any questions from chapter 7? Not during class, but I would be happy to answer questions from the problem. If you're stuck on something, just send me an email and I'll take a look at it. We can always schedule time if we need to. So if there aren't any other questions, we'll move on with chapter 8. So chapter 8, you can see the title of chapter 8 is receivables. Most of what we talk about in this chapter will be accounts receivable. That's a term that we've been using since chapter 1. And we will spend a little bit of time at the end talking also about notes receivable. So accounts and notes receivable. You can see the learning objectives there on the screen. We will be going over each one of those learning objectives. And just like in the previous chapter, I didn't do a fantastic job of ordering the exercises in Cengage. So we're going to skip the first exercise. We'll come back to it when we finish the chapter on Thursday. So again, we'll be talking about accounts receivable primarily. Most of the focus for this chapter then is on learning objective 4, the allowance method of accounting for uncollectible accounts, uncollectible receivables. So what does that mean? We allowed someone to buy on credit and then they can't or won't pay us when the bill comes due. So how do we deal with that from an accounting standpoint? The term receivable, as you know, means that somebody owes us and they are going to pay us later. We made an agreement that they could pay at some point in the future. Accounts receivable generally result from sales of whatever it is we sell, product or services, to our customers, where we reach an agreement about when, how long they can take to pay. We've talked about terms of sale in chapter 5. So the concept of buying on credit should not be unfamiliar to you at this point. Notes receivable are similar to accounts receivable in that someone owes us money and they're going to pay us later. But the main difference between accounts and notes receivable is that notes receivable include interest. So when we get to that part of the chapter, we'll be learning how to calculate the interest on those notes receivable and to calculate due dates and other accounting techniques like that. So receivables are typically, especially accounts receivable, are going to be current assets. And for many companies, they are a significant part of their current assets. We include them as a financial asset. So when we're looking at the concept known as quick ratio. So remember, we looked at current ratio back in chapter 4 when we learned how to do a classified balance sheet. So we know that working capital and current ratio both use the total current assets in the calculation. There's another version of that, though, a little bit more stringent calculation called the quick ratio, also known as the acid test for a company. And in that quick ratio, the denominator is still the current liabilities, but the numerator, rather than being all of the total current assets, we limit that to the financial assets, the assets that we have that we can quickly turn into cash, or maybe already are cash. And so accounts receivable is part of that acid test or that quick ratio calculation. However, we're dependent on our customers paying us before we have that cash available. Some companies may not have the working capital or the float to allow them to wait for their customers to pay them in the future. And so they might do something known as factoring. They might factor their receivables. That is, they sell them to some other company whose job it is then to collect from those customers. There's a section in the book that talks about factoring, and I'm not going to talk about, we don't have any exercises related to factoring. I'm not going to talk much about it in class, but make sure, please, that you read that part of the chapter. So let me see. So, yep, those learning objectives are not telling me where it is, but it's in there. If you do have questions about that, even though we're not talking about it in class, if you do have questions about it, you should ask. I would be happy to talk a little bit more about it, but as you know, I like to keep our focus in class on the doing part of accounting, not so much the conceptual piece, except as it's needed to understand the doing part. So what you should take away from this is that sometimes companies may not have the luxury of waiting for their customers to pay them, which might be 30, 60, 90 days down the road or something like that. And so they may employ a middleman to help with that collection process to get their cash flow faster, but at a cost. So they're paying a fee to those factoring companies. Really, the use of credit cards like Visa and MasterCard is a form of factoring in the extreme, in that you pass the responsibility of collection to the banks that issue the credit cards that you accept. So you're not accepting any risk that the customer won't pay, but you have a fee for that. As we discussed, 2 to 6% generally of that revenue is going to go to pay the credit card expense. There's factoring with recourse and without recourse. A credit card such as Visa or MasterCard is really an example of factoring without recourse. What that means is if your customer doesn't pay Visa, Visa can't come back to you and say, hey, your customer didn't pay us. The burden, the onus is on the credit card company, the bank that issued that credit card, to do all of the collections and to handle that end of the transaction. Factoring with recourse would be you sell the receivables, you factor them, you sell them to an outside entity, kind of like a collection agency. And if the customer doesn't pay, that company can come back to you and say, hey, your customer didn't pay, here's your receivable back. We need our money back. Again, we've talked about credit terms already. So the concept of agreeing that your customer can pay sometime down the road should be familiar to you. We know that accounts receivable are typically going to be collected within, a month or two. And so that makes them a current asset as well as a financial asset that would be included in that quick ratio or asset test. We're going to put off talking about notes receivable, other than you're aware that notes receivable do include interest. Typically, notes are going to have a little bit longer term, but generally it would be less than 1 year, so they would still be considered a current asset. If we do allow our customers more than 1 year to pay, that makes them no longer a current asset because they're not going to turn into cash within 1 year. And so in that case, we would classify them as investments. Some examples there of other receivables: interest receivable. So we've earned it, but it's not going to pay until maybe that note matures. Taxes receivable. So if we have billed our customers and that includes sales tax or an excise tax of some kind, that could be categorized separately. Receivables from officers or employees, that's possible. These are much less common and not something that we are actually going to see in class. But you know that anytime you see that term receivable, it means that someone outside the company owes us money and they're going to pay us later. But let's talk about that last clause there. They're going to pay us later. Do we know for sure they're going to pay us? Is there a 100% chance that a customer is going to pay us when we allow that customer to buy on credit? No. We're accepting a risk that someone may not pay us. Do we know at the time we make the sale who's not going to pay? Do you think there's ever a time where we say, Joe Smith is probably not going to pay us, but that's okay, we'll sell to him on credit anyway? Do you think that happens a lot? Probably not if we want to stay in business. Probably not. So let's think about how this fits in. And there's the reference to factoring, so I already talked about that. Let's think about the matching principle. In chapter 3, when we talked about cash basis versus accrual basis accounting, we said accrual basis accounting is what you have to do for GAAP, generally accepted accounting principles in the United States. The matching principle says we record revenues when we've earned them, and we have that 4-step test to know if we've earned them. We have an agreement between the buyer and the seller. The price is fixed or determinable. We have delivered the product or performed the service. And step 4, which in chapter 3 I told you is the one, we're just going to assume that's in place unless we're told otherwise. Step 4 was reasonable assurance of collectibility exists. In other words, we believe the customer is going to pay us. So by that definition, if we know Joe Smith isn't going to pay us or isn't likely to pay us, we can't even claim that revenue because there's reason to believe that he's not going to pay. And that violates step 4 of that 4-step test the SEC has established for us to know, how do we know if we can claim that revenue? So, in summary, we allow customers to buy on credit, but we don't have an ironclad guarantee that every one of them is going to pay us. But we don't know who's not going to pay us. Because if we did, we couldn't claim the revenue in the first place, and we don't even have to have this conversation. Everybody with me so far? Okay. Anyone with questions? All right, so back to the matching principle. We record revenues when we earn them based on that 4-step test. We know we can't claim the revenues if we think we have reason to believe the customer is never going to pay us. The second part of the matching principle is, and what do we match against those revenues? The expenses that helped us to generate those revenues, the costs associated with making those sales. So how does that fit in with uncollectible receivables? Well, if we know that, or we expect that maybe some of our customers might not pay us, that's a cost of doing business. That is an expense associated with extending credit to our customers. So the matching principle says we have to record that expense at the same time we record the revenues. That's what the match is, revenues, expenses on the income statement. So if we sell to someone on credit and it turns out they're not going to pay us, do we know that? We already said we don't know it at the time we make the sale. Do we likely know it in the same month? Let's say we make a sale to someone on October 15th, just a couple days ago. We make a sale to them on October 15th and we say, you've got 30 days to pay. Are we going to know by October 31st when the month ends and we're closing our books? Are we already going to know that that person's not paying their bill? What do you think? If we told them, pay us on November 15th, are we going to know on October 31st they're not going to pay us on November 15th? No. Okay. That is the basis for what we're going to be doing in the first part of this chapter. And it's the main focus of this chapter. We record the revenues in October. The matching principle says, well, you have to record the expense that goes with it, but we don't know yet who's not going to pay. Because maybe their bill isn't even due this month. So what do we do about that? The answer to that question is that we have to estimate. We don't know that Joe Smith isn't going to pay us, but we have to estimate in total, how much are we not going to collect? Just to put numbers on it. Maybe we allowed customers to charge $1,000, just because I like to keep the numbers a little bit smaller. We allowed customers in total $1,000 worth of receivables this month. We allowed them to buy on credit $1,000 worth of whatever it is we sell. We don't know who's not going to pay, but we can look at that $1,000 possibly and say how much of it we might not collect. Even though we don't know it's going to be Joe Smith, we can estimate of that $1,000, how much are we not going to collect? Or another way of looking at it is, we can look on the balance sheet and see how much is owed to us in total. Maybe our customers owe us $5,000. Our receivables right now are worth $5,000 in total. And we can look at that $5,000 and maybe look at some detail of that $5,000 and say, how much of that $5,000 are we not going to collect? So it's an estimate because we don't know for sure, but we have to, I'm just going to use the word guess. We have to guess how much are we not going to collect? Either of the sales that we have this month or the amount that's due to us, and those numbers are going to be different because there might be some carryover from last month, bills that haven't been paid yet because maybe we give them 60 days to pay. And not all of our sales might be on credit. Maybe we have some cash sales. Certainly, we probably have some sales that are on credit cards, which is a totally different question because they don't owe us the money, they owe their bank the money. So that is the explanation for everything we're going to do in this first part of the chapter when it comes to uncollectible accounts. We don't know. That's right. Yes, it's essentially immediately that we receive that payment from the credit card company. And yes, it's then, the transaction is then between the credit card company and the customer who used their credit card. The only exception to that would be if we didn't get it authorized and it was a fraudulent use. So, they always authorize the credit card. So once the credit card company says, go ahead and accept the credit card, it's on them. But if you, let's say that, sometimes the system is down, and I don't know if this happens anymore. I haven't seen it happen in a long time, but it used to be that they might actually run a physical charge slip where they had this. Have you guys seen those? Do you know what I'm talking about? Or is this far too old for you? It's been a few years. But there are some locations where, they didn't used to have a little square that you could swipe it and, would be on the remote locations. And so if you weren't there where you had the phone line or the computer line to do an authorization, you might just swipe the card and do the authorizations later. So if you took a card, it wasn't authorized, then you'd have some liability for that. You might not get paid. But as soon as the credit card company authorizes that purchase, it's on them. Yes. Yep. Yeah, and we did see that. I'm trying to think what it might have been chapter 5. We did see that in a couple exercises. I think it was chapter 5, where we talked about what it would look like if you accepted credit cards, and then we had a separate one of the exercises. There was a separate entry for the credit card expense, because you do have to pay a fee based on the size of your company, how much you have in credit sales, based on which type of card it is, MasterCard and Visa. So American Express and Discover have higher fees associated with them. So does that answer your question? So what we're talking about here, just to summarize, is customers who have a credit account with us. So they owe us the money. This isn't using a bank credit card. This would be like if you have a Kohl's charge card or a JCPenney credit card, where you actually owe JCPenney, not the bank. It's not a separate Visa card. And certainly if you are a wholesaler and you're selling, full truckloads, you may not have a financing arm of your company, but you're probably selling on credit to all of your major customers at least. So any other questions before we get to, so how do we do this? How do we estimate that? Where does the number come from? How do we know, hopefully now, you get why we have to record the expense in the same period that we record the revenues. Even though we don't know yet for sure, that means we have to estimate. So the focus of the next few exercises is going to be, how do we do that estimating part? Anybody with questions? Other questions? So how do we do that estimating part? There are two different ways we could accomplish it, but only one of these we are going to cover. Only one of these is acceptable under GAAP. You can see the two methods on the screen right now. The direct write-off method means we only record that expense when a customer actually doesn't pay us. Now, this is the way we do it for tax purposes. The direct write-off. Joe Smith actually doesn't pay his account on November 15th. We make repeated attempts probably to try to collect from him. Maybe we send him a certified letter, whatever. We reach out, maybe we make a phone call, maybe we send it to collections, and he still doesn't pay. Only at that point where we just give up, say, you know what, clearly he's not going to pay. We're just going to write it off. At that point, under the direct write-off method, is when you would report the expense. Well, all those steps I just described probably take a little while, maybe at least a few months. And so under the direct write-off method, it violates the matching principle, because the expense does not end up in our records on our income statement in the same period as the revenue. That's why the direct write-off method is not acceptable under GAAP, because it violates the matching principle. And so but it is what we use for taxes. That may be the first time. No, we talked about it in the inventories chapter as well. There's been at least one other time then that I have pointed out to you a difference between what we're learning in this class, which is financial accounting, and what is acceptable for tax purposes. So there are definitely some differences. Sometimes there are timing differences. So for financial, we might report it earlier, and for tax purposes, it might be later. Sometimes it's a permanent difference of what we're allowed to report on our financial accounting statements and what is acceptable for tax purposes. You're not responsible for knowing what the tax rules are. This is not a tax class, but I do want you to be aware that they're of exactly what type of accounting you're learning in this class, and where there might be some major differences like that. So what we are learning in this class is the second bullet, well, I guess it's the third bullet point on this slide, the allowance method, where we estimate the uncollectible accounts and match it. We report that expense at the same time as we report the revenue. And so we will see two different ways of estimating that expense. You're responsible for understanding both ways. And we will also see how we go about writing off an account once we actually say Joe Smith didn't pay and we give up. Sometimes that might happen, that write-off might happen because Joe Smith goes through bankruptcy, and the bankruptcy judge notifies us that that debt has been discharged in bankruptcy. So we don't have a legal right to try to continue to collect. Sometimes, unfortunately, it could be because the person passes away and leaves no estate that we can try to collect from that estate. And sometimes it might just be a combination of those things that we saw on the previous slide. Customer isn't responding, maybe he or she has left the area. We decided that it's not worth our time and effort and continued expense to try to collect on that debt. And so we just kind of throw our hands up and say, you know what, I give up. He's not going to pay. Let's just write it off. So we're going to be doing the allowance method, two different approaches, and you're responsible for knowing both of them. Let's go to our exercises then. That's enough of me talking for now. Go to our, whoops, I don't have it open, our chapter 8 exercises. Remind other people to open theirs, and I didn't even get mine open. As I said, we're going to be skipping the first exercise. We'll be coming back to that at the end of the chapter on Thursday. So let's get started with exercise number 2, the nature of uncollectible accounts. And really what we're going to see in this exercise is that uncollectible accounts vary from one industry to the next. So remember we talked about those comparisons and the 3 standards of comparison. And I said, anytime we're doing a calculation, a financial ratio or some other calculation, in order to know if it's good or bad, we have to know what we're comparing. What are we comparing it to? I don't know, compared to what? So in this case, we're going to be comparing from one industry to another, and you'll see that there are vast differences, that there are extreme differences between those two that we're looking at in this exercise. And what that tells us is that there is no rule of thumb. So that was one of the standards of comparison that I talked about. And there is no rule of thumb that's going to work in all circumstances, or even in most circumstances for uncollectible accounts, because it really depends on the industry in which you're operating, what's expected or typical. So maybe comparing to an industry average would be more appropriate in this case. And as always, you can compare to what happened in your company the previous period or over some number of years as a trend analysis. So MGM Resorts International owns and operates hotels and casinos, including the MGM Grand and the Bellagio in Las Vegas, Nevada. As of a recent year, MGM reported accounts receivable of $707,278,000. I'm going to make a comment about that. I'm going to put a word over here at the edge. That is what is known as their gross accounts receivable. And gross in this context, gross in the accounting context means total. So that $707 million and change is how much they are owed in total. However, they don't really think they're going to collect all of that. And if we go on to the next line, it tells us the allowance for doubtful accounts has $94,561,000 in it. In other words, of the $707 million that they're owed, about $100 million of that, they don't think they're actually going to collect. That's a pretty high percentage. And that's what we're asked to calculate here in part A, is what percentage, compute the percentage of the allowance for doubtful accounts to the accounts receivable for MGM. So we're asked to take the dollar amount in that allowance account, divide by the gross or total receivables. And round to 1 decimal place. So what did you get? Anyone have a number for that? Anyone have a number for that? Thank you. 13.4%. 13.4%. So for every dollar that MGM is owed right now, just the two of you guys on the team. Okay, good luck. For every dollar that MGM is owed, there's about 13.4 cents that they don't think they're actually going to collect. So on their balance sheet, this is what you would see. Probably, you would see accounts receivable. I'm going to abbreviate that, AR, net, whoops, net. And the net accounts receivable is the amount that they think is collectible. So the 95 million represents the amount they think they will not collect. And the difference then, I just subtracted. The difference is the net amount, the amount that they think is collectible. And that's what would show up on their balance sheet. You probably on the balance sheet would not see both of those numbers. You wouldn't see the 707 million. You wouldn't see the 95 million. What you would see is the 612,613,000 that they think is collectible. And then if you go to the notes to their financial statements, which as we've discussed in class before, follow right after the financial statements themselves in the annual report, usually about 2/3 of the way, maybe through the annual report toward the end, you would find the notes to the financial statements, and you should find a note about their receivables that gives you information like this detail. Here's how much we're owed in total, 707 million. Here's how much we think is not collectible. But on the face of the balance sheet, on the document itself, you'd probably only see accounts receivable, comma, net. Net of the allowance. We've already subtracted the allowance from the total amount that was due. Make sense? Okay. Let's look at the next sentence then. Johnson & Johnson, J&J, manufactures and sells a wide range of healthcare products. What does that J and J mean again? Why do they have J and J in parentheses like that? Anyone remember what that is? That's what it stands for, but what does that symbol mean? Where is that used? It's their stock, it's their trading symbol, right? So Johnson & Johnson manufactures and sells a wide range of healthcare products, including Band-Aids and Tylenol. As of a recent year, J&J reported accounts receivable of $14,707 million and allowance for doubtful accounts of $226 million. So their receivables are much, much higher. They're owed almost $15 billion from their customers. But their allowance amount is, as a percent of the whole, much smaller. Go ahead and calculate that percentage. Anyone get a number for that? 1.5. So 1.5% compared to 13.4%. So Johnson & Johnson, I'm just going to say, is almost certainly a much, much larger company than is MGM Resorts International. And that explains why their receivables in total, their gross receivables, would be so much higher than MGM's. But as a percent, their allowance is much, much lower. It's only about a 10th. So question C, why is that different? Do we think A is true? Casino operators historically lose money on operations. Do we think casinos are losing money in the long run? No, of course not. If they were, there wouldn't be casinos. Letter B, casino operators have larger accounts receivable. Is that true based on the information we have here? No, their receivables are much smaller, dollar for dollar, in absolute terms. How about letter C? Individuals who may have adequate creditworthiness could overextend themselves and lose more than they can afford if they get caught up in the excitement of gambling. Do we think that's probably true? Could be. How about D? Casino operators experience greater bad debt risk because it is difficult to control the creditworthiness of customers entering the casino. Do we think that one's true? Yeah. So probably C and D are true. I would suggest, I'm not sure why, I think D is probably true. But so you can't control the creditworthiness of people coming into the casino, but you absolutely can control to whom you extend credit. And that's true for every company. There is no requirement ever that you extend credit to any customer. It is a business decision that you are going to extend credit at all. And some companies do not. If you go into Wegmans to do your grocery shopping, are they going to offer you that you can just start an account and they'll mail you a bill next month? As an individual shopper, no matter how much you're buying, even if you're feeding a family of 10, are they going to give you credit in Wegmans? No. There may be, I don't know, there may be some institutional buyers who have credit with Wegmans. That's certainly possible. But the average customer going into Wegmans is not offered credit. Wegmans has made a decision that they don't run accounts for random people off the street. Because just like letter D says, they can't control the creditworthiness of people coming into the store, but they make a decision, but we're not going to give anyone credit for the most part. It is a business decision how much credit to extend. And for some companies, the answer is we don't offer credit. And for other companies, it might be we extend credit to people even who are credit risks. So as you know, I'm not from Jamestown. I'm not as familiar with the businesses around here. But I strongly suspect if I were to drive through Jamestown, I would find a small car dealership selling used cars that has a sign out that says something like buy here, pay here, or let's get you financed. Let us help you get financed. We finance everyone, or something like that. I suspect that's true. So that business has made it a part of their business that they will extend credit even to people who may not have a great credit rating. Why do they do that? And other companies don't. You know, if you go to a new car dealership, you may not be able to get credit there where you might be able to get credit at one of those buy here, pay here kind of used car lots. Why is that? What do they do? How do they make it in business? How do they make it a profitable business model to lend to people who might have poor credit?
Oh, they charge higher interest rates or no?
Yes, they absolutely charge higher interest rates. They might even charge more for the car itself than it's possible that the exact same car at a lot like that might go for a higher price than a car at a new car dealership that also sells used cars. So if you have poor credit, you can still buy a car, but in the long run, you're going to end up paying more for it. Why is that an acceptable business model? Why are those places allowed to exist? If we're saying you end up paying more for the same car, why is that allowed to happen? Because that business is taking on extra risk. They're saying, we know you've had credit problems in the past. We know you still need a car and we want to help out with that, but you're going to have to pay more for it because we're taking the risk that you might not pay at all. Unfortunately, it's kind of a two-edged sword because you charge them more and that makes it less likely they can pay for the car, right? So you might become a self-fulfilling prophecy, to use the psychology term. Casinos, back to this exercise, casinos extend credit to people who might not have great credit because they're taking the chance, they're accepting the risk that in the long run, it will work out better for them, that they'll end up making more money by extending credit to people who otherwise might not be creditworthy. The same reason, I think we talked about this back in chapter 5 when we talked about the credit card expense back in chapter 5. The same reason that some companies have decided to accept credit cards, even though they know it costs them more, that 2 to 6% fee, but they know that if they accept credit cards, they're going to sell to people who otherwise wouldn't buy from them if they couldn't use a credit card. They know that the average sale using a credit card is going to be higher than an average cash sale. And so they do a trade-off. It's going to cost us a little more, but our extra revenues are going to make up for that. So I don't really like the wording of letter D. Of course, it's difficult to control the creditworthiness of customers entering the casino, unless you are banned from the casino because of, poor behavior or whatever. Unless you're banned from the casino, it's a public place. People are allowed to just come in, but that doesn't mean that the casinos have to extend them credit. So I don't really like that wording. All right, let's move on then. If there aren't any questions? Any questions? Okay. So I said, as I talked about the allowance method, and I said there are really two different ways of estimating those uncollectible accounts. I've really already given you a picture of what those two methods are. I said, we can either look at our sales for this period and say, okay, our sales were $1,000 on credit. How much do we think isn't going to be collectible? Or, so that's looking at the income statement. So sometimes that's referred to as the income statement approach. Sometimes it's called the net sales approach or the net sales method. So one of these two methods looks at the income statement. How much did we record in revenues this period? How much of that do we think is not collectible? The other approach looks at the balance sheet. So it's called the balance sheet method or balance sheet approach, or it's sometimes called the AR, meaning accounts receivable, AR aging method. So what does the term aging mean? Well, as we look at accounts receivable, it's not enough to know that, looking at this example, this is our third exercise. So we can see right here, this is a subtotal of $1,050,000. Ignore the stuff that's at the bottom for now. We'll get to that. But assume for now that that table at the top, and obviously this dotted line means that they have excerpted a bunch of stuff that comes between A and Z. These companies looks like they were in alphabetical order, starting with Acme and ending with Zollinger. And there's a whole bunch of stuff in the middle that they've just taken out because it's too much to put on the screen. But if that was our whole accounts receivable, what that would mean is $1,050,000 is how much our customers owe us. And this analysis shows for each customer how much they owe. So looking at Acme, Acme owes us $3,000. But we need to know how old is that invoice. It might be just one invoice. It might be 2 or 3 or 10 invoices or more. So we need to know, when did our customers buy that from us? When was it due? Because the newer an invoice is, the more likely it is that our customers are going to pay us. The flip side of that, the older an invoice is, the less likely our customer is going to pay us. The longer it is past due, the more likely it is that we are going to end up writing off that invoice. Doesn't mean we won't collect any of them that are past due, but the longer it is past due, the less likely it is that we will ever see that money. So looking at Acme, Acme owes us $3,000, but it's not even due yet. So the likelihood of Acme paying on time is still pretty good, still really high probably. But let's look at Zollinger Company down here at the bottom. They owe us $5,000, but that $5,000 is between 31 and 60 days past due. It's more than a month, but not 2 months past due. So the chances of us collecting from Zollinger, who has allowed their bill to go more than a month past the due date, the chances of collecting from them is much lower than our chance of collecting from Acme. Again, we don't know that Zollinger isn't going to pay. Because if we knew they weren't going to pay, we would have already written that account off and it would not still be showing up in our accounts receivable. Once we write it off, it's off the books. We aren't going to continue to show that they owe it because we've determined they're not paying. But the chances of collecting this $30,000 out here that our customers owe us, but it's more than 3 months past due, the chances of collecting that $30,000 is much, much lower than the chance of collecting this $600,000 that's not even due yet. Does that make sense? You agree with that rationale? The older an invoice is, the more likely it is that we're going to end up eating that invoice, not getting paid for it. Everyone agree with that? Okay. So the AR aging approach or the balance sheet approach looks at each one of these totals on the aging. So this aging has 1, 2, 3, 4, 5 categories. Your company gets to decide how many categories to use. It could use 3, it could use 10, probably not, that's probably too much detail. 5 seems like a nice number, but there's no magic about that 5. It could be that they have, they end with over 60 days past due. There's no reason they have to have that. The only reason they would add additional categories is if they think it gives them even better information. Remember, we're using this information to estimate. And so we'd only want to make it more complicated if it gave us a better estimate. So we've got this whole aging here, but then they recognize that, oh, some of our customers, for some reason, were left off the spreadsheet. We're left off this aging schedule. And so our job for this exercise is first to calculate how many days past due it is, and then to show that down here to add those to our aging so that their aging is complete. So we'll start out first with calculating the number of days past due, because that will tell us where they go in the aging. And then we'll scroll down and do the actually updating the aging. So the technique, excuse me, the technique we're going to be using here is also going to be helpful for us when we get to the notes receivable part of the chapter when we're trying to calculate interest. If you do not know how many days there are in any given month, please do not just guess, because it will make your answer wrong. Please do not just guess. If you don't know, look it up. I would bet that virtually everyone in here has a phone that has a calendar function on it. If you don't know how many days February has, look at the calendar and see, please. But then you should try to learn how many days there are in each month. So we are looking at this aging as of July 31st. Boyd Industries had a bill that was due on April 7th. So we want to know, as of July 31st, how many days past due is that bill? In order to do that calculation, we need to know how many days are there in April. Well, there are 30 days in April. So the first 7 days of April, it wasn't past due. So that invoice was past due 23 days in April, plus all of May, which is 31 days, plus all of June and all of July. And so that's going to be our calculation for how many days past due the invoice is to Boyd Industries. And that works out to be 115 days past due. So if it's 115 days past due, which category is that going to go in? So Boyd owed $36,000. So I can put the 36,000 here in the balance column. But which one of these columns does it belong in? If it was 115 days past due, it belongs all the way out here in the days past due over 90. Right? Let's look at Hodges Company then. Their invoice was due on May 29th. So May has 31 days, but for 29 of those days, it wasn't past due yet. It was only past due on the 30th and the 31st, or 2 days, plus all of June and all of July. Everybody okay with what we're doing here? Okay, go ahead and fill in the next 3 on your own. I'm going to pause the recording to allow you to do that. Okay, so I have filled in all the rest of those. The August 10th invoice to Lockwood Company isn't past due yet. It's not due until the next month, and so we're told to put in a 0 there. So now with those days, we can come down and complete the rest of this aging. These boxes that are here in the top part of this, those are not necessary. I'm not sure exactly why they put those there. We're just going to ignore those. That part of the aging is already done for us. That's just carried down from the top. So we'll start with Hodges Company next, 11,500, and that's 63 days past due. So 11,500 in the balance column, and that would be in the 61 to 90 day category. Any questions about what we're doing there? Okay, so I'm going to pause the recording again to allow you to finish this up and then put your totals in, adding from the subtotal column down to the total line. And then restart the recording. Okay, so I have filled in the rest of the aging. We have now added those 5 companies that were accidentally omitted from the original aging. We've now added those in. And so we have our totals across the bottom. Now that we understand what's on the aging, we can see how in our next exercise, how do we use that information? How do we use this information to help us with the allowance method for recording uncollectible accounts? So let me put my green check marks in there. Make sure I don't have any math errors, and we'll move ahead to our next exercise. And what you'll notice is that the next exercise includes those same totals that we just calculated in the previous exercise. Okay. So there's all those numbers, same company here then, Evers Industry. They have looked at, they've produced their aging. I should point out that it's kind of weird, very unlikely that the scenario we saw in the previous exercise would actually happen. Because where do these agings come from? They come from the computerized accounting information system. And we just hit the button and we tell the computer, hey, produce us an aging for everything that was due to us as of July 31st. And the computer just generates that report for us. So I don't know how those other accounts would have been left out, if somehow they were coded wrong. I don't know. Don't know. But now they look at the bottom of that report, you'll notice they're not looking at any of the individual companies. You don't see Acme, you don't see Lockwood, you don't see Zollinger listed here. We don't need to know any particular customer. How much does that customer owe us? We're looking at this from the big picture. Because remember, we don't know, for example, that Acme is not going to pay. If we knew Acme wasn't going to pay, we couldn't have recorded the revenue from that sale in the first place. If we knew Acme wasn't going to pay, we would already or should already have written off their account. It shouldn't still be in our accounts receivable if it was there in the first place. It shouldn't still be there if we know for sure they're not paying us. And so the only thing we need are these totals that I have highlighted, the totals that we calculated in the previous exercise. So what do we do with that? Well, we've already established that the older a receivable is, everyone agreed with me, the older a receivable is, the less likely that we're ever going to collect that. And that's the pattern that we see in this table that's provided here at the top. For the 5 classes or groupings on their aging, from not yet past due to over 90 days past due, for each one of those classes, we have assigned a percentage that we think we won't collect. And so for those invoices that are not yet past due, we think that there's a chance we won't collect 1% of those. And you'll notice the percentage goes up and up and up until we get to that final one, over 90 days past due. We think there's a 75% chance that we're not going to collect those. or 75% of that total will not be collectible. Where do you think those percentages come from? We know they're estimates, but how do we even know what numbers to estimate for each one of those groupings? Where do you think those come from? Any guesses? If you were this company and you were trying to figure out, I don't know, the invoice is 3 months past due, what are the chances we're going to collect that? Where do you think that estimate comes from? How would you go about guessing at that? What do you think would be useful information to know? Well, we haven't collected any of it yet. But what kind of records might we want to look at to figure out how much of it we think we probably won't collect? Do we have any records, do you think, that might help us answer that question? What kind of records? Do you think it would be helpful to know what happened last year? Year before? That historical information? Absolutely. We'd want to know, well, I don't know what happened before. Because do you think that MGM and Johnson & Johnson, back to our first exercise from today, do you think that MGM and Johnson have the same historical patterns? Probably not, right? So MGM knowing what Johnson & Johnson did or have had happen, probably not very helpful. But MGM looking at what happened last year, it's going to be really helpful in establishing these percentages. What else might be helpful to know? Do you think that there are certain times, economic times, for example, that affect our customers' willingness and ability to pay their bills? Do you think right now in 2022, when we're in a recession, when we are actually in a recession, do you think that it's more likely or less likely that companies are going to collect from their credit customers today? More likely or less likely? Less likely, right? So why? Because we're in a recession. We're in a recession. So that affects business because, God bless you. So 2 years ago, 3 years ago, when things were going better, companies were more willing and able to pay their bills. Customers were more willing and able to pay their bills than they are today. So it's not enough just to look at what happened last year, but we also have to take into account any other factors that we might know, like what's happening in the economy. And it may not be the national economy, it may be the local economy. So if a major employer in Jamestown closes, that might impact the ability and willingness of small customers to pay their bills because maybe they just got laid off or their spouse got laid off or something. It affects them. And so it's not enough just to look at the national. You want to look at what's happening locally as well and take that into account. We know this is an estimate, but we want it to be the best estimate we can come up with. And it's not going to be perfect, but we want it to be as close, as realistic as possible. And so let's go ahead and do these calculations. So in the category not yet past due, we have $607,400 total that our customers owe us, and it's not even due yet. Of that amount, we think 1% is going to be eventually uncollectible. 1% times $607,400 is $6,074. Okay, so of the not yet past due accounts, we think 6,074 might be uncollectible. For the next category then, 233,000, that's already past due, but not more than a month. And so 3% of 230,000 is $6,990. Go ahead and do those calculations across. And once you have each one of those individual categories on the aging, you can add across to the left to get the total amount that we think is uncollectible. So if I added those correctly, Evers Industries wants to have $106,106 set aside. This is not actual money. They don't put cash into a separate bank account. That's not what I mean. On the balance sheet, we set aside that value as the allowance for uncollectible or doubtful accounts. Sometimes it's called the allowance for bad debt. I think that expression has mostly gone out of favor. You usually hear doubtful or uncollectible accounts. So they're set aside this $106,106 in the allowance, and that reduces their net accounts receivable. That allowance account, by the way, is a contra account. The allowance for uncollectible accounts, I'm just going to abbreviate it that way, uncollectible accounts is a contra asset. It's a contra asset account. What does that mean? It has a normal credit balance. It goes against the asset accounts receivable. It has a normal credit balance. We've seen one other contra asset account so far this semester. Anyone remember what it was? It's listed with the assets, but it has a normal credit balance. Anyone remember? We talked about it in chapter 3. It's come up a couple times since then. And we're going to see it again in chapter 9. The other one that we've talked about is accumulated depreciation. And so on Evers Industries balance sheet, what you would likely see is their accounts receivable, comma, net is $1,018,394. They're owed $1,124,500, but 106,000 of that they don't think they're going to collect. It's an estimate. Maybe they'll collect a little more, maybe they'll collect a little bit less, but this is the best we can do with the information we have right now. We want to show on the balance sheet that we believe of what we're owed, we believe we can collect about $1,018,000. Any questions about this? So this is one method of calculating that allowance, of determining how much do we need to have in that allowance account on our balance sheet. So at this point, you should be familiar, comfortable with what an aging is and how we would apply these percentages, where those percentages might come from. For our purposes in class, you don't have to come up with those percentages. In fact, you might not even have to do this part of the calculation again. The total might be given to us. It definitely is in some of the exercises. But any questions about what we've done so far? I'm going to pause just for a moment here. I'm going to pause the recording and ask you to try this exercise on your own. It is very similar to what we just did in the previous exercise. We have Outlaw Bike Company. They are owed $1.4 million, and they're trying to determine how much they need to have set aside in that allowance account. So you're given the balance for each one of their categories on their aging. You'll notice they have 6 categories on their aging. As I told you, it's totally a individual business decision, which categories and how many to use. If they're using 6, the assumption is that's because it gives them better information than if they only use 5 or 4. And adding 7 doesn't give them enough more information to make it worth the extra work. So again, I'm going to pause the recording and ask you to complete this exercise on your own, and then we'll come back together in just a minute or two. Okay, so when I did all of the extensions, that is multiplying across and then adding down for this company, we can see that they've identified that they need to have $63,195 in that allowance account. And I've just put a note on the screen to remind you that on their balance sheet, they would just show not the total amount that's due to them, but the amount that they think is collectible, $1,357,505. That is the gross or total accounts receivable down here, the 1.4 million, minus the amount that they have targeted for their allowance account. My green check marks in there. And we'll keep going. And so again, this exercise is kind of paired with the previous exercise, and the calculations have already been done for us. These are the same calculations we did in the last exercise. So we have that total amount of $63,195 that we know we need to have in the allowance account. But I already told you that the allowance account is a contra asset account. That means that it is a balance sheet account, and that means that it's a permanent or real account, and it carries its balance forward. So, and I'm just going to abbreviate this, allowance for uncollectible accounts, UA, allowance for uncollectible accounts. So since that is a balance sheet account, God bless you. Since that is a balance sheet account, unless this is a brand new company, there's probably something already in that allowance account. It probably does not have a zero balance right now. I'm just going to label this for us as a reminder. So the debit side, the credit side, this is a contra asset account. Whoops, contra asset account. And so that means it has a normal credit balance. I put the plus on the credit side to remind us that even though it belongs with the assets on the chart of accounts, even though it belongs with the assets, it still has a normal credit balance. And so what does this tell us? Assume that the allowance for doubtful accounts for Outlaw Bike Company had a debit balance of $6,225. Again, it's a permanent or real account, and it almost certainly has a balance that's carrying forward from the prior period. There might even be some activity in that account, because as you'll see when we get to another exercise, when we write off an account, we write it off to the allowance. That's what the allowance is for. So it's not enough for us to know that this amount, $63,195, is how much we need to have in that allowance account. we need to do a bit of calculating here. Because what does that tell us? That 63,195 is what I referred to as the target balance. That's how much they want to have in that allowance account. 63,195 on the credit side. But right now it has $6,225 already on the debit side. So what is the entry we need to make so that the ending balance in this allowance account is 63,195 credit? What's the entry we need to make? Can anyone tell me? What do we have to do to this account to make the balance not be 6225 debit, but instead be 63,195 credit? What do we need to do? What do we need to do here? Jeopardy theme song is playing in my head. Pretty sure everyone's writing your answers down on your screen, and unfortunately, I can't just then show your screen up here like you do on Jeopardy. What do we need to do? Add what? Okay, 6225 plus 63,195. In case you said that, I've already added those together, and the total is $69,420. Now what do we do? So I had to add those two numbers together. Now what? What do I do with that number? $69,420. What do I do with that? On the debit side? If I put it on the debit side, what would happen? So if I put it right. Okay, but if I debit this account, what's going to happen? Is it going to give it a credit balance if I debit this account? So what do I need to do to this account? What's the other option? If I don't want to debit, what do I want to do? How about credit? What if I credit this account? 69,420. The first 6225 wipes out that debit balance and brings it back to zero. And then it keeps going to the credit side. If there's a 6225 debit balance and I add 69,000 on the credit side, it's going to leave me with the ending balance of 63,195, which is exactly what we said we wanted in there. They looked at the aging, they did the calculation, we did that in the previous exercise. We know there should be 63,195 in that account on the credit side. As I said, that's our targeted balance. So how do we get it there? We have to credit that account, credit the allowance. So they called it doubtful accounts. I called it uncollectible accounts. It's the same thing. We need to credit 69,420 to that account to bring it to the balance that we know should be in there, because we analyze the aging. We know it should have 63,195 in there. It doesn't. So we have to make an adjusting entry to bring it up to the balance that we want, 63,195 credit. Now we know we can't just have a credit without a debit. And remember, the whole point of what we're talking about here is employing the matching principle. If we're going to record the revenues, we have to record the revenues from those credit sales. We have to record the cost or the expenses that go with those. And the expense is bad debt or doubtful accounts or uncollectible accounts. Remember, an adjusting entry always has to have at least one balance sheet, one income statement account. The allowance account is the contra asset, it's a balance sheet account. So we need an income statement account that's going to be the expense. We are reporting about $70,000 worth of uncollectible accounts or bad debt expense for this period. Because we reported those revenues on credit. We allowed customers to buy on credit. We have reason to believe that all of them aren't going to pay. We estimated that about $63,000 of the amount that's owed to us isn't going to be collectible. So we need to have that set aside on our balance sheet. Make sense so far? Remember, this is just one approach. This is, by the way, this is the one that's more difficult. The other approach is much easier, cleaner. So let me clear my drawings there. Right where I wanted to be at the end of class today, because we just have about 2 minutes left. So far, just to recap before we finish, the matching principle tells us if we're going to allow customers to buy on credit, we have to take that into account and estimate how much additional cost we're going to have. Now, keep in mind, this expense isn't us paying somebody. It's really just reducing our income. So nobody's mailing us a bill for this bad debt expense. It's not like utilities expense or rent expense or salaries expense. But it's an offset to the revenues. We've recorded the revenue because we sold the customers on credit. But we know when we sell to them on credit, we're taking a risk that some of them won't pay. We don't know who, but we have to estimate how much. This is one of the two ways that is acceptable under GAAP to estimate that so that we can record the expense in the same period that we record the revenues. And we're halfway through the chapter. Any questions about where we are right now? On Thursday, then we'll introduce the other method, and then we'll be talking about notes receivable, and we'll end with how do we use some of this information to make decisions about a company, that financial statement analysis piece. All right, see you. Oh, let me say one more thing, by the way. 1 week from yesterday, advisement open if you are in one of two groups at JCC. If you are part of the honors program at JCC, or if you are a military veteran, advisement starts October 24th. Everyone else, if you're not in one of those two groups, everyone else, advisement starts the next Monday, which is October 31st. Some of you may not have an advisor assigned, depending on who you saw over the summer, if you're brand new to JCC. Some of you may have had an advisor who retired, because if you were here last year, as you know, we had, over the last couple of years, we've had a number of full-time retirements. That's why I'm here. If you need a business advisor, I can see you in my office hours Tuesday, Thursday, or on Zoom on one of the other days of the week. And I'll be putting advisement hours into Starfish. I would encourage you to sign up for an appointment with me or whoever else your advisor is, so that you get the classes that you want at the times that you want. All right, that's it. See y'all Thursday.
See ya.
Bye-bye. Hope you guys are feeling better.